Good afternoon. So when you look at Rsk4805, we look at market risk. And when you look at market risk, please take note. There are chapters that the textbooks say we must go through. Always make sure that if you're going to be going through those chapters in advance, check to see, always use the guideline of the study guide, which shows you the learning units as well. So for Rsk4805, which is market risk, you have 9 learning units. And from the 9 learning units, you see that each learning units there are different chapters in the textbook that they refer you to cover as well. And even in some chapters as well, there are certain sections that they will expect you to cover. And there are certain sections as well that they tell you to leave out. So please make sure that if you're going to be going through the different chapters in the textbook in advance, try as much as possible, or not try, always use the guideline of the study guide, which shows you what you should cover in each and every study unit. Otherwise, you end up doing things that necessarily are relevant for the exam as well. So I'm going to give you a quick rundown of the study units that we're going to be covering, but I'm not going to base it on the difference on this, what they say in the study guide. I'll give you the rundown depending on exactly what is given in the textbook. So please take note on the chapters that I'm going to give you a rundown on. They're not necessarily in the same sequence as they expect you to cover in the study guide, because in the study guide, there are some chapters, like for example, you will see that chapters 1, 2, 3, 4, and 5, and chapters, I think chapter 4 as well, we do them sequentially. Then from then onwards, you will see that on learning unit 2, we are going to be referred to another study, another chapter, which is a bit forward in the textbook. Then they guide you on exactly which sections in that chapter you need to be covering. And you will see that certain learning units as well, they are going to be asking you to cover or even more than one chapter in the textbook as well. So certain learning units, they'll be having one chapter, and other learning units are going to be having 2, 3, or even 4 chapters that they expect you to cover in the textbook. So because of this, please always use the study guide provided by the lecturer to go through the material in the textbook. Very, very important. So if you look at the material in the textbook, you'll see that Chapter 1 looks at the introduction. So you look at the introduction, where you look at what is risk, how do you calculate the risk, and how do you calculate the expected return? Because chapter 1 is basically trying to show you that there's a relationship between risk and return. So given that there's a relationship between risk and return, how do you calculate risk? How do you calculate expected return? And also, how do you calculate the return of the portfolio? And how do you calculate the risk of a portfolio, which is, remember, the risk of a portfolio or the risk of an asset in this case, we're going to be looking at calculation of what? The standard deviation. Then chapter 2, so learning unit 1, we go through chapter 1 of the textbook. Then for learning unit 2, we go through chapters 2, 3, and 4 of the textbook. And here, chapter 2 looks at, learning unit 2, we are going to be looking at financial institution and their trading. But remember, it's not necessarily in this sequence, because we're going to be looking at chapters from chapter 2, we look at chapter 5, and later on we're going to look at chapter 5, then we're going to look at chapter 7, but not necessarily in this sequence. You have to use the sequence that is given in the study guide provided by the lecturer as well. So you see that learning unit 2 looks at chapter 2, which looks at financial institution and their trading. So to see exactly how is the trading done, and how what are the different risk factors that you're going to be looking at from the perspective of the banks, from the perspective of insurance companies and pension plans, and from the perspective of what? Mutual funds, exchange-traded funds, and hedge funds as well. Then later on, we are going to look at chapter 5, which looks at trading in financial markets. Then we are never going to do chapter 6. Then chapter 7 looks at the valuation and scenario analysis, the risk neutral and reward as well. We're going to be looking at this, and this is another highly examinable section. Then part 2 of the textbook looks at market risk, right? Which is basically the core principles or the core of what we are doing in market risk as well. So you see that chapter 8 looks at how traders manage their risk, and we're going to look at that in detail. And chapter 9 looks at the interest rate risk, and which is also related to what? To market risk, but we're going to look at to see exactly what are the different components that makes up your market risk as well. But in particular, when it comes to market risk, we're going to be more concerned with what? Interest rate risk. Then chapter 10, we're going to look at volatility and how to measure volatility. And we're also going to look at chapter 11, correlations. We're not really going to look at copulas, but we're going to be looking at what? Correlations in chapter 11. Then chapter 12, we look at calculation of what the value at risk is and what the expected shortfall is. And we're going to be looking at the calculation of the value at risk and expected shortfall. And remember, chapter 12 is where you are going to be, there is no way you're going to be writing an exam without being asked on chapter 12. So expect this. And chapter 13 looks at the historical simulation and the extreme value theory. But what is more important here from chapter 13 is the historical simulation. And you see that chapter 13 is very much related to chapter 12 as well. So which means, I think in chapter 13, we only look at 13.1 and 13.2. That's why I say, whenever you're going to be going through the curriculum for Rsk4805, strictly follow what the lecturer is saying we should be covering. So you need to go in the same sequence as what the lecturer is saying we should be covering. To say learning unit 1, remember there are 9 learning units, so which means you need to follow to say learning unit 1, what chapters am I supposed to cover? And even in those chapters, am I expected to go through everything, or there are certain sections I'm expected to go through, and which sections I'm expected to leave out as well. Very, very important. Then chapter 14 also looks at model building approach, which is also another highly examinable concept there. Then the third part of the textbook looks at regulation. And when you look at regulation, now we look at the evolution of the Basel Accords. So we're going to look at the Basel 1, the Basel 2, and the Solvency 2, which is basically, so the Basel 1 and 2 and 3 are basically more on the banking side. And the Solvency 2 is the one that is more on the regulation of insurance companies as well. So you see that the Basel 1, 2, and 3, and 4, they are more on the regulation of banks. And then there is the Solvency Act now is the one that is more on the insurance side. So you need to be able to know and understand the different components and how they've developed over time as well. So this basically means that you need to be able to go through chapters 15, 16, and 18. So you need to go through chapter 16, 15, 16, and 18. And I'm sure these ones, they're in one study unit because you need to go them in together. I think 15, 16, and 18, they're in one study unit, which means that you are going to be going through them in under one learning unit as well, under one learning unit that you're going to be covering. So it's 15, 16, and 18, and it's more to do with regulation of the banking and insurance industries. Then chapter 18 looks at the fundamental review of the trading book, because you will see that when it comes to the bank books, you will find that there is the trading book, and then there is the forgetting the other book as well. So which means that you're going to be reviewing the trading book. And the idea here is where we've seen that historically there has been the issue of rogue traders, where the rogue traders have actually, we have a situation where the rogue traders have done the trading for the bank, and they've gone beyond the mandate and taking the risk more than what they should be taking as well. So which means that when you now look at the fundamental review of the trading book, you're now trying to find out exactly how do you ensure that the different traders are also going to be working within the limitations of the trading limits within the bank system as well. Then 19 all the way forward to 28, there's nothing that we expect you to cover from those chapters. Then the last study unit, which is study unit 9, is where we're going to be looking at risk management mistakes to avoid. It's a very short chapter. Usually, in the previous years, it has taken us about 30 minutes to an hour to go through this chapter. So there isn't much that you need to know, but it's a highly examinable section as well, because usually the lecturer brings it as what? As theory questions. So these are the chapters that are going to be covering, but please take note, they are not necessarily in this sequence. You have to use the sequence that is prescribed in the study guide from the lecturer as well. So please take note of that. So when you look at learning unit 1, under topic 1, so under topic 1, we have what we need to cover is learning unit 1 and all the way to 3. So if you look at learning unit 1, 2, and 3. And here they say, topic 1 covers learning units 1 to 3 and introduces market risk management, including sources and challenges of market risk management, concepts related to risk and return, which is in learning unit 1, an overview of the financial services industry, which is in learning unit 2, and the regulatory requirements of market risk management, which is in learning unit 3. So first complete the short quiz and that, okay, it's fine. We don't have to worry much about that. Then under learning unit 1, they say you have to work through chapter 1 of the prescribed textbook. And they say, please note if you are unfamiliar with any of the topics discussed, you have to do additional reading on your own to update your knowledge on these topics as well. So under learning unit 1 on chapter 1, we need to look at the introduction to market risk. And then we have to look at the categories of risk, where we see that when you look at the categories of risk, risk can broadly be described, can broadly be split into financial risk and non-financial risk. And financial risk is where you find credit risk and operational risk, and also you find what? Market risk. And here under market risk is where you're going to be looking at commodity risk, equity risk, exchange rate risk, and interest rate risk. And for Rsk4805, we're going to be leaning more towards this issue of what? Interest rate risk. Then when it comes to non-financial risk, this is where you look at the reputational risk, legal risk, technology risk, strategy risk, operating environment risk, money laundering risk, and control risk as well. And these are some of the non-financial risks that you can also encounter or look at as an organization as well. So on looking at the sections that are going to be covering in chapter 1, we look at the sources of market risk management. Then we're going to look at the challenges in market risk management. And then we look at the concept relating to risk and return. And we also need to look to see exactly how do you calculate the expected risk and how do you calculate the standard deviation as well, which is basically the return, risk and return concepts as well. Then from there, we look at the efficient frontier, so that we are analyzed to see exactly, so why does one need to be finding, why does one need their portfolio to be found on the efficient frontier? Then on we need to 1.5, we're going to be looking at the capital asset pricing model, and breakdown of the capital asset pricing model. And 1.6, we look at the risk and return, risk versus return for companies. And 1.7, we look at risk management by financial institutions. And 1.8, we look at the credit ratings as well. But you see that 1.6, 1.7, 1.8 is just 1 or 2 paragraphs that we need to cover in under each of those sections as well, because it's mostly theory. So we are now going to look at chapter 1 of the textbook. So we are now going to be looking at chapter 1 of the textbook, which is found under learning unit 1. Are there any questions before we look at chapter 1 of the textbook, which is under learning unit 1? Any questions? So under chapter 1, here they say, as the chief risk officer, it is your job to consider how the new venture fits into the company's portfolio. So what is the correlation of the performance of the new venture with the rest of the company's business? When the rest of the business is experiencing difficulties, will the new venture also provide poor returns, or will it have the effect of dampening the ups and downs of the rest of the business? And then you also look to see exactly the companies must take risk if they are to survive and prosper, So the risk management function's primary responsibility is to understand the portfolio of risks that the company is currently taking and the risk it plans to take in the future. So it must decide whether the risks are acceptable, and if they are not acceptable, what action should be taken. So what does that mean? It means when you look at risk management for an organization, as the risk officer, your job is to identify the risk, analyze the risk, and then present the risk to the board, right? Then the board is the one that is going to decide to say, okay, fine, depending on the amount of risk factors that we're looking at or our risk exposures, this is how much risk we're going to be taking, depending on what? The risk appetite of the overall organization. Because remember, the board is the one that is going to determine to see exactly, so what is the overall risk appetite of the organization? Then, now, when the board is determining the risk appetite of the organization, it is now your job as the risk officer to ensure that you do the monitoring and reviewing of the risk that the organization is going to be taking over time as well. So because of this, that's why we see that we always say the risk management function is not only going to be separated as a function, separate function on its own, because it's going to be we have seen that in modern risk management concepts, risk management should be very much intertwined with the functions and activities of the other activities of the organization or the departments of the organization as well. So to understand this better, they give us table 1.1, and here under table 1.1 they say they give us the 1-year return from investing 100,000 in stock, right? So they give us the 1-year return from investing 100,000 in stock. So the reason why we're given this information or this table is because this table is leading us on to section 1.1, where we look at risk versus return for investors. So we're going to come back to this table as we're now going to be analyzing further the risk versus return for different investors as well. So here they say, as all fund managers know, there is a trade-off between risk and return when money is invested. The greater the risk taken, the higher the return that can be realized. Remember, it's not the actual return, it's the return that can be realized. So it's basically an expected return. So just because you're taking on more risk does not necessarily mean that you're guaranteed of a particular return. But you have a higher chance of getting that return as well. So here they say the trade-off is actually between risk and expected return, not between risk and actual return. So the term expected return sometimes causes confusion. In everyday language, an outcome that is expected is considered highly likely to occur. However, statisticians define the expected value of a variable as its average or mean value. So expected return is therefore a weighted average of the possible returns where the weight applied to a particular return equals the probability of that return occurring. So the possible returns and their probabilities can be either estimated from historical data or subjectively. So they give us table 1.1. And from table 1.1, we now need to look to see exactly how do you determine the expected return for a particular portfolio where you're investing 100,000, given the probabilities and the returns as well. So given this information, we now need to know, we know that if you have done this at undergrad, we know that the expected return, which is sometimes given as the return with the bar on top, and sometimes they refer to it as the mean, which is the mu, is given as the sum of the returns multiplied by the probability of those returns. So the sum of the return multiplied by the probability of those returns give you the expected return. So this means if we go back to our portfolio, from the given portfolio, we are given the probabilities of the returns and we're given the returns. So when you're saying that the expected return is the sum of the return times the probability, it basically means that for each scenario, you are going to be multiplying the return multiplied by the probability of us getting that return. Then you are now going to be adding up the weighted values of what? Of those returns, and that gives you what? The expected return. So which means in this case, our expected return would be given as, for the first scenario, the return as a decimal is 50%. The return is 50% positive. So it's going to be 0.5 multiplied by the probability, which is 0.05. Remember, you're summing up the different scenarios, so which means that we're not going to say, for the second scenario, what is the return multiplied by the probability? So which means for the second scenario, your return is given as 30%, which is 0.3, multiplied by the probability, which is given as 0.25. The next scenario, your return is 10%, so it's 0.1, multiplied by the probability, which is 0.4, plus the next scenario, your return is minus 10%, so it's minus 0.1, multiplied by the probability, which is 25%, which is 0.25, plus the return is minus 30%, so it's minus 0.3, multiplied by the probability, which is 0.05. So given this information, how much is the expected return as a decimal? So how much would you get as the expected return in decimal form? Are we getting the same amount? Are we getting the same amount? Any questions? Anyone lost? Are there any questions, or is there anyone lost? Please take note. When it comes to market risk as a module, we are going to be doing a lot of calculations. So when it comes to market risk as a module, we're going to be doing a lot of calculations, more than, I believe, other modules that for when you look at risk management. So which means, because of this, you need to be very familiar with your financial calculator, right? So my advice is usually that you can, if you, I know many students, because they had calculators at undergrad, they probably will be having the Sharp financial calculator or the HP financial calculator as well. If you're having the Sharp financial calculator, it basically means that because you're able to punch in everything exactly as is, you should be able to punch in everything exactly as is. Where there's a bracket, you put a bracket. Where when you're making a value negative, you press plus minus button on your calculator to make the value negative. And where there's a closing bracket, where there's an addition, you put it exactly as is. You should be able to get the answer directly. If you're using the HP calculator, it's a little bit more trickier because you're not able to see the brackets. There is a way of putting the brackets, but usually what I would advise is for students using the HP calculator, it means you have to break down your calculations into different components. Then you add up the values together to get the ultimate answer as well. Over time, as we are going through the calculations as well, those who are using if you are good at using your HP calculator, you can continue using your HP calculator. Usually, I would advise that you get a normal scientific calculator, because most normal scientific calculators, you're able to see where you're putting brackets and where you're closing brackets, because our calculations are going to be getting a little bit more and more and more complex as well. So you will find that sometimes you have calculations where you're calculating the E of X, the E of something, and sometimes you have calculations where you are going to be calculating the ln of something, but in most cases, you're going to be looking at the E of something as well, the E of X. So because of this, or you're going to be putting something to the power of a multiple way division as well. So to make your life easier, if you have the HP Sharp calculator, scientific calculator, or normal financial calculator, you can use it. But if you have the HP calculator, you need to be knowing how to use a financial calculator very well. If you are struggling with it, rather get a normal scientific calculator where you're able to see that you've opened brackets, you've closed brackets, you've multiplied, because it makes your life a lot easier. The reason why I'm saying this is mainly because you will see that when it comes to the market risk exam, market risk, there's a lot of calculations. Remember, they changed the curriculum 2 years ago, and even before they changed the curriculum, the previous curriculum, where we were looking at market risk from a derivative perspective only, there was a lot of calculations that you're going to be doing. And also, please take note, I always get this comment from the students for all the years that I've been teaching market risk as well. Students always complain that there is a very small mark allocation, and when you look at your calculation, it's a very long calculation that you're doing. So you see that in some cases, even if you look at past papers as well, if you look at past papers or past assignments, you'll see that it's going to be a very familiar case where you're going to be doing a very long calculation. Then after that long calculation, you see that you're only doing that calculation for 4 marks. But if you look at the amount of work that you've done, it's quite a lot. Which means that if you're going to be doing a lot of questions are going to be long calculations with a very small mark allocation, we know that the longer the calculation, the higher the probability that a student has of making a mistake, especially under exam conditions. So what does that mean? It basically means that to reduce the probability of you making a mistake, you need to be very familiar with how to use your financial calculator. So you also see that there are some topics or chapters that are going to be going through, and we will spend a big chunk of the day going through a very small portion of the textbook as well. Mainly because we have to make sure that you as a student, you understand how to use your financial calculator. So on my side, whichever financial calculator you're using, I should be able to know by head roughly what you should be doing and how it's structured as well. So when you are going through these calculations as well, if you're struggling with your calculator, please ask me questions and ask me to say, I can't get this answer. There's something I'm doing with my calculator there. Then you tell me which calculator it is that you're using. Then I can try to guide you so that you know and learn how to use a financial calculator. Because there's nothing as painful as knowing the concept, but getting the answer wrong because you are making a mistake when using a calculator as well. So it's very, very important that you know and master the use of your financial calculator. Very, very important. Are we on the same page? Any questions? Next, on the next section, we look at quantifying risk. And when you look at quantifying risk, the quantifying of risk for when you look at market risk, we're going to be looking at quantifying total risk, which is measured by what? By standard deviation. So when you look at standard deviation, they tell us that the standard deviation can be given using this formula. But what I'm going to tell you is you can calculate your standard deviation using this formula, or you can calculate your standard deviation using the other formula that we're already familiar with as well. Because remember, your standard deviation, we also know that, I'm sure you have seen this in undergrad as well, to say, to calculate your standard deviation, first step, calculate your expected return. Second step, calculate the variance, where the variance is given as the sum of the return minus expected return, which is the expected return that you've calculated here, squared multiplied by the probability of the returns. So this will give you the variance. Then from there, the standard deviation is given as the square root of the variance. I'm just going to demonstrate to you that the method given in the textbook and the method that I'm sure that you're already familiar with from, because usually when you're doing your undergrad, whether you do INV or you do financial management or anything, even risk management as well, they usually use this particular method on how to calculate the standard deviation as well. So which basically means to get the standard deviation in this case, we're going to say the standard deviation is equal to, for the first scenario, your return is 0.5. The expected return is 0.1. You square that, multiply by the probability of this happening, which is 0.05. Just want to cross check to see. Just want to make sure that it's the right figures that I'm dealing with. For return and probabilities, the return is 50%, probability is 0.05. Okay, yeah. Then you go on to the next scenario. Your return is 0.3. The expected return is 0.1. You square that times the probability of 0.25. Plus, the next scenario, your return is 0.1. Your expected return is 0.1. You square that times the probability of 0.4. Plus, the next scenario, your return is minus 0.1. The expected return is also 0.1 squared multiplied by the probability of 0.25. Plus, the next scenario, your return is minus 0.3. Your expected return is equals to 0.1 squared multiplied by the probability of 0.05. So given this information, how much do you get as your variance? So how much would you get as your variance? So how much do you get as your variance?
$0.04.
Let me quickly check. Yes, I'm here.
0.04.
Now, this brings us to another issue as well. When you do your calculations using your using your calculator, always try to put your calculator into at least 4 decimal places, if possible, even 5. Right? So if you're using the Sharp calculator, you press, if you're using the Sharp financial calculator, to change the number of decimal places, you press set up, then you press 0, you press 0 again, then you indicate the number of decimal places you want. If you want 4 decimal places, then you press 4. If you want 5 decimal places, then you press 5. So with the Sharp financial calculator, to change the number of decimal places, you press set up 0, 0. Then if you want 4 decimal places, you press 4 after that. If you want 5 decimal places, then you press 5. If you're using the HP financial calculator, to change the number of decimal places, you press Shift, then you press DISP. DISP is the one where the equal sign is. So if you press Shift, you press DISP, then after that, you indicate how many decimal places you want. If you want 4 decimal places, then you press 4 after that. If you want 5 decimal places, then you press 5 after that. So that's basically how you change the number of decimal places. So with the Sharp calculator, to change the number of decimal places, you press set up 0, 0. If you want 4 decimal places, then you press 4. If you want 5 decimal places, then you press 5. With the HP calculator, to change the number of decimal places, you press Shift. And then after you press Shift, remember, Shift is that button with an arrow pointing down, right? So you press Shift, then you press DISP, because remember, the reason why you're pressing Shift is because you want to access the buttons with the yellow function or orange function, depending on exactly how your calculator is as well. Then after that, if you want 4 decimal places, then you press 4. So the answer that you're saying 0.04 is mainly because you're in 2 decimal places. The actual answer should be 0.036. And how we get to that actual answer, we're going to say, for the first one, you get 0.008 plus. For the second one, you get 0.01 plus. The third one, you get 0. The fourth one, you get 0.01 plus. Then the fifth one, you get 0.008. And if you add them up together, you should be able to get 0.036. So you should be able to get 0.036. 0.0036. Are we on the same page? Any questions? Anyone lost? From the variance, we can now calculate the standard deviation. Remember, your standard deviation sometimes is represented with theta, right? So your standard deviation is given as the square root of, so your standard deviation is the square root of 0.036. And how much do you get? So if we say the square root of 0.036, how much do you get? To 4 decimal places, how much do you get?
It's 0.1897.
0.1897. And if you multiply that by 100,
18.9737.
so it's about 2 decimal places on your final answer. It will be 18.97%. Are we on the same page? Any questions? Anyone lost? Any questions? Anyone lost? So if you check in the textbook, you will see that when they look at quantifying risk, they use this other method, and you see that you get to the same answer as well. I don't want to teach you this other new method, mainly because I'm sure at undergrad, the method that we're using was this method. So it's rather stick to the method that you know, because there's a lot of other new things that you're going to be learning going into the future when it comes to calculations as well. So rather stick to what you know on how to get the answer, so that you are able to now know that if you're calculating expected return, this is how you calculate it. If you're calculating standard deviation of an asset, this is how you calculate it as well. Are we on the same page? Now, the calculations that we've been doing so far was calculating the expected return and risk of a single asset. So the calculations that we've been doing so far was calculating the expected return and the standard deviation of a single asset. So if they ask you to calculate the expected return or standard deviation of a single asset, this is how you do the calculation. Are we on the same page? So please take note of this. So if you're asked to calculate the expected return and the standard deviation of a single asset, this is how you should be able to calculate it. Now, on the next section, we look at investment opportunities. And here they say, when you look at the flow of investment opportunities, it basically means that the relationship between the expected return and the standard deviation is generally something like this. That's why you see that in general, the higher the expected return, the higher the standard deviation. Because remember now, this is why we're saying that the higher the expected return, the higher the risk. So the more risk you're taking, the higher the expected return. Or the more expected return that you want from your investment, the more you should know that you're going to be what? Exposing yourself to what? To more risk as well. Now, we, apart from calculating the expected return and standard deviation of a single asset, you can also look at calculation of the expected return and the standard deviation of a portfolio of assets. Now, for Rsk4805, we are going to be, when it comes to the expected return in the standard deviation of your portfolio of assets, in most cases, we limit it to what? To two assets as well. Especially when it comes to the standard deviation of the portfolio, we always look at the standard deviation of a portfolio of what? Of two assets. Although it's possible to calculate the standard deviation of a portfolio which is made up of what? Of more than two assets, although it becomes way much more complicated. But for Rsk4805, we limit it to calculation the calculation of the standard deviation of the portfolio which is made up of what? Of two assets. So they give us that information. So now, when it comes to a portfolio of two assets, so when it comes to the portfolio of two assets, we are going to look at the two assets being asset 1 and asset 2. So we're going to look at the two assets being asset 1 and asset 2. So which means in general, the expected return of your portfolio is equal to the sum of the returns multiplied by the weights. So the returns of the different assets multiplied by the weights of the different assets. If you sum them up together, this will give you the expected return of the portfolio. And the expected return of the portfolio, sometimes they refer this to as the mu of the portfolio. So if they say expected return of the portfolio, or you see that they represent it as mu of the portfolio, they're talking about what? One and the same thing. So now, it also means the expected return of a portfolio, which is made up of two assets, asset 1 and asset 2, will be equal to, for asset 1, you're going to say the return of asset 1 multiplied by the weight of asset 1 plus, because remember you're summing up. For the second asset, it will be the return of asset 2 multiplied by the weight of asset 2. So if a portfolio is made up of two assets, it means the expected return of the portfolio would be the return of asset 1 times the weight of asset 1 plus the return of asset 2 multiplied by the weight of asset 2. So this will give you the expected return of a portfolio which is made up of what? Two assets. Are we together? Now, please take note. The return of asset 1 and 2, what does that mean? Individually, you can now calculate the expected return of asset 1 so that you're able to get the expected return of the portfolio. So individually, you can now calculate the expected return of asset 1, and individually, you can now calculate the expected return of asset 2 so that you see exactly what the expected return of the portfolio would be as well. So sometimes you can individually, you calculate the expected return of asset 1, just like what we did when we're looking at the single assets. And then you're going to look at the expected return of asset 2, just like we did that with the single assets as well. And remember, when you're looking at the return of asset 1 and 2, this is where we said, when you're now calculating these expected returns of asset 1 and 2, this is where we say the expected return of your single asset is given as the return multiplied by the probability of that return. So if you calculate the expected return of asset 1 and you calculate the expected return of asset 2, and you determine the weight of asset 1 and 2, you should be able to calculate what? The expected return of the portfolio. Are we together? Any questions? Anyone lost?
Reynolds, how do we determine the weight of each asset?
Now, the weight of each asset is determined by how much is invested in that asset. So the weight of each asset is determined by how much is invested in each asset. Let's say, although it's not given in our example, let's say, for example, you have asset A, right? You have asset A, and for asset A, you calculate the expected return of asset A, which you got to be 10%. And you also see that in asset A, the value of investment in asset A is equals to, let's say it's 60,000, right? That's how much is the value of the portfolio asset, or how much is the value of the asset A in the overall portfolio. Then you also have asset B. For asset B, let's say you calculate the expected return of asset B, and you got the expected return being equal to, let's say, 12%. And then the value of your investment in asset B, let's say asset B is worth 40,000. So what do we see? To calculate the expected return of the portfolio, do you see that we have the expected returns given to us already? If they're not given to you, just like what we did when you're now looking at the single asset, you can still calculate the expected return of the single asset using this method, right? So that's how, let's say those ones, the expected returns are given, but what you're not given is the weight. So which means you're now going to say, to determine the weight of each asset, you're now going to say the value of asset A is equal to 60,000. The value of asset B is equal to 40,000. So the total value of the portfolio is equal to 100,000. Are we on the same page? So which means the weight of asset A is equal to the value of investment in asset B over the value of the portfolio, which means in this case it's going to be 60,000 over 100,000, and you get a weight of 0.6. And your weight of asset B in this case is going to be equal to the value of asset B divided by the value of the portfolio, which is equal to 40,000 divided by 100,000, which will give you a weight of 0.4. Are we on the same page? Are we together then? So this would mean, the expected return of the portfolio, which is made up of these two assets, asset A and asset B, is going to be equal to remember we said the expected return of the portfolio is going to be the return of asset 1 times the weight of asset 1 plus the return of asset 2 times the weight of asset 2 as well. So which means in this case is equal to the return of asset 1, expected return of asset 1, which is 0.1, times the weight of asset 1, which is 0.6, plus the expected return of asset 2, which is 0.12, times the weight of asset 2, which is equals to 0.4. Remember, this is 0.4. So how much do you get as the expected return of the portfolio? How much do you get at the expected return of the portfolio? How much do you get? Are we together there? Any questions? Any questions? Anyone lost? Okay. Now, furthermore, please take note as well. In the textbook, they say the weight, is it weight of asset 2 or weight of asset 1? So that I'm a bit more consistent. Yeah. The weight of asset 2 is equal to 1 minus the weight of asset 1. So the weight of asset 2 is equals to 1 minus the weight of asset 1. Since your portfolio is made up of 2 assets, it means if you have the weight of asset 1, you can now be able to calculate the weight of what? Of asset 2. Just like what we did here. It means as well, the weight of asset B is equals to 1 minus the weight of asset A. Going back to our hypothetical example. So going back to our hypothetical example, the weight of asset B is equal to 1 minus the weight of asset A. What do we see? Here, we saw that the weight of asset A was 0.6, right? And we're having a 2-asset portfolio. So it also means that 1 minus 0.6 should give us the weight of asset B, which is equal to 0.4. So which means that now that we have the weight of asset A, we don't have to go back and say the weight times the amount invested. We can simply say 1 minus the weight of asset A would give us the weight of asset 2, because our portfolio is made up of what? 2 assets. And the weight should always add up to 1. So please take note, weights add up to 1 or add up to 100%, and the same probabilities add up to 1. If you put them as percentages, they also add up to what? 100%. So if you probabilities and weights, if they're given as decimal, they add up to 1. Probabilities and weights, if they're given as percentages, they add up to 100%. Are we together there? Any questions? Can we move on? Now, going back to the information that they give us, we need to just quickly go through the example that they give us there. So here they say, suppose mu for asset 1, which is the expected return for asset 1, is 10%, and the standard deviation of asset 1 is 16%, and the mu of asset 2 is 15%, and the standard deviation of asset 2 is 24% per annum. Suppose also that the coefficient of correlation between the returns is 0.2. Table 1.2 shows the values and the number of different values of weight of asset 1 and 2. So the calculations show that by putting part of your money in your first investment and part of the second investment, a wide range of risk-return combination can be achieved. So far, we have seen that when it comes to the portfolio or a 2-asset portfolio, your expected return of the assets is given as this, the return of asset 1 times the weight of asset 1 plus the return of asset 2 times the weight of asset 2. Now, let's also see how do you determine the risk of a portfolio. So the risk of the portfolio, which is shown by the standard deviation, is given by that formula. So based on that, So based on that, it means the standard deviation of a two-asset portfolio, the standard deviation of a two-asset portfolio is given as the square root of the weight of asset 1 squared times the standard deviation of asset 1 squared plus the weight of asset 2 squared times the standard deviation of asset 2 squared plus 2 times the weight of asset 1 times the weight of asset 2 times the correlation coefficient between asset 1 and 2 times the standard deviation. Let me just indicate that I'm multiplying here so that there's no confusion, times the standard deviation of asset 1 times the standard deviation of asset 2. So this will give us the standard deviation of the portfolio. The reason why I'm giving you this way is because we need to know, have a bit of consistency, because how they give us in the textbook is more or less the same as what we have. But there's another important point that I need to indicate here, that also take note now that the correlation coefficient of asset 1 and 2 times the standard deviation of asset 1 times the standard deviation of asset 2 gives us the covariance of asset 1 and 2. Why I'm giving you this is because sometimes in the exam, instead of giving you the correlation coefficient, they will give you the covariance. So if they give you the covariance, you know this part of the equation is already done for you. Are we together? Any questions? Anyone lost? So going to the example that they give us in the textbook there. So going to the example that they give us in the textbook, they tell us that if you look at the information plotted in the textbook, right? They give us different combination of weights and the resulting expected return and standard deviation. So they give us different combination of weights and the resulting expected return and standard deviation. So, for example, if we look at this, the third combination there is where the weight of asset 1 is 0.4, the weight of asset 2 is 0.6. Now we need to find out exactly, so what is the expected return of the portfolio given those weights, and what is the standard deviation of the portfolio given those weights as well. We are also given that for asset 1, the expected return is 10%, the standard deviation is 16%. For asset 2, the expected return is 15%, and the standard deviation is 24%. And we're also given that the correlation coefficient between the two assets is 0.2. So given this information, it would mean if we are to calculate the expected return, remember we say the expected return of the portfolio is given as the return of asset 1 times the weight of asset 1 plus the return of asset 2 times the weight of asset 2. So this means that if you're going to be looking at those two assets, it would mean the expected return of this portfolio is going to be equal to, given that the weight of asset 1 is 0.4 and the weight of asset 2 is 0.6. So it also means that the expected return of this portfolio is going to be equal to the return, the expected return of asset 1 was 10%, so it's 0.1, times the weight, which is 0.4, plus for asset 2, the return or the expected return was 15%, which is 0.15, times the weight, which is 0.6. So given this information, how much do you get as the expected return of the portfolio? So if you calculate the expected return, how much do you get? How much do you get? Remember here, you must be able to get 0.04, and here you must be able to get 0.09. So this will give you 0.13, and if you multiply that by 100, you get the expected return of the portfolio being equal to 13%, which is exactly what they have there. If you look at that table. Are we on the same page? Any questions? Now, you can also be asked to find the standard deviation of these two asset portfolio. And to calculate the standard deviation of this full asset portfolio, we're going to say the standard deviation of the two asset portfolio is going to be the weight of asset 1. Remember, we said asset 1 is the weight of 0.4. So it's going to be 0.4 squared times the standard deviation of asset 1. If you check on the information that we're given, asset 1 had a standard deviation of 16%. So as the decimal is 0.16 squared. Plus the weight of asset 2, which is 0.6, times the standard deviation of asset 2, which is given as 24% per annum. So it's 0.24 squared, plus 2 multiplied by the weight of asset 1, which is 0.6, times the weight of asset 2, which is equal to 0.4, multiplied by the correlation coefficient between the two assets is 0.2, multiplied by the standard deviation of the first asset, which is 0.16, multiplied by 0.24. So given this information, how much do you get as the standard deviation of the portfolio? So how much would you get as the standard deviation of the portfolio? in the exam, they will tell you, if you look at the first page of the paper, they will tell you how many decimal places to round off your in-between calculations. Then if they are expecting you to round off your calculations to more than the stated number of decimal places on the first page of the paper, they will specifically tell you to say, for this question, round off to 6 or even 8 decimal places, your in-between calculations as well. Although normally your final answer is usually rounded off to what? To 2 decimal places. Are we on the same page? Any questions? Anyone lost? Remember, you don't want to lose marks because you're making mistakes on calculating the square root of. You're making mistakes when calculating 0.4 to the power of 2. If you don't know how to do it, please ask now.
Mr. Reynolds, I just need some clarity on, you know, where you say what do you call that? The part where you highlighted in green, basically. I'm just trying to find out how can you break that down for me?
The correlation coefficient between the two assets.
Yeah.
So as a formula, we can say, as a formula, the covariance of asset 1 and 2 is given as the correlation coefficient of asset 1 and 2 times the standard deviation of asset 1 times the standard deviation of asset 2. So as a formula, it's broken down into this. So what I was trying to say is that if on the question you need to check to say, are they giving me the correlation coefficient or are they giving me the covariance? If they give me the covariance, it means instead of doing the calculation here, you're just going to put the figure that they give you as the covariance. Are we together? Like, for example, if they had said the covariance, is equal to 0.00768, if they said the covariance is equal to 0.00768, it would mean when it comes to this part of the calculation, instead of calculating this part, you are just going to replace this with 0.00768. Then this 0.00768, you would multiply it to the weights of the two assets, and you would multiply to each to 2 on the other side, on this side of the plus sign. Are we together there?
Yeah.
All right. Yeah. Any other questions? Any other questions? Now, looking at the possible weights and the resulting expected return and standard deviation, if you look at table 1.2, on table 1.2, do you see that they give you different combination of weights and the resulting expected return and standard deviation? So what do we see? From the different combinations there, we see that the For when your standard deviation is 24, okay, the lowest here, when your standard deviation is 14.54, your expected return is 11%. When your standard deviation is 14.87, your expected return is 12. When your standard deviation is 16.00, your expected return is 10%. When your standard deviation is 16.89, your expected return is 13. When your standard deviation is 20.09, your expected return is 14. And when your standard deviation is 24, your expected return is 15%. So they are basically saying this information can be plotted on a graph. So this information can be plotted on a graph. So this information can be plotted on a graph. So this information can be plotted on a graph where we are saying, for example, when your standard deviation was 15 point something, your expected return was around 10%. And we saw that when your standard deviation was somewhere below 15%, your expected return was equal to somewhere here. And for this combination, where your standard deviation was equal to this, your expected return was found somewhere there. It's not as accurate, but somewhere very close to that. And for this combination, where your standard deviation is somewhere around here, we were seeing that this information, the expected return corresponding to the expected return was plotting somewhere there. And for this combination, I'm not sure if it's exact, but the information, the figures are already given there as well. The expected return was that. And for this amount of standard deviation, the expected return was somewhere there. It's not the exact figures, but I'm just estimating them. So we are plotting the information given on that table onto this graph, which shows the relationship between the standard deviation and the corresponding expected returns. Are we on the same page then? So as an investor, please take note of this. As an investor, you seek to maximize the return for a given level of risk. So for a given level of risk, you want to maximize your returns. And at the same time, the investor seeks to minimize the risk for a given level of return. Let me use a more simplified graph, right? Let me use a more simplified graph. Remember, just to highlight the information that we were given already, we were given on our calculations that they were given the combination of the expected returns and the standard deviations. Let's do away with the information that is given there. Let's look at it in simple terms. Let's say you're given this graph, which shows you the standard deviation against the expected return. Then they tell you that we have asset A, we have asset B, and we have asset we have asset C, right? And if you look at how they plot, so they give you the combination of the returns and the standard deviation. So if you're asked to choose between the two assets, if you're asked to compare between asset A and B, which one would you choose? If you're asked to choose between asset A and B, which of the two assets would you choose? To make it a bit more simpler, let's say here the standard deviation is 5%, and here the standard deviation is 7%. The expected return is 14% here, and the expected return is 18% there. So given this information, if you're asked to choose between asset A and B, which one would you choose between the two, and why? If you're asked to choose between asset A and B, which of the two assets would you choose, and why would you choose that asset? Do you see that if you're asked to choose between asset A and B, for the same amount of risk, A is giving you a higher return than B, isn't it? So here, we're going to choose asset A, isn't it? Because for the same amount of risk exposure, asset A is giving you a better return than asset B, considering that you're taking what? The same amount of risk. And if you're asked to choose between asset B or C, which one would you choose? If you're asked to choose between asset B or C, which of the two would you choose, and why? If you're asked to choose between asset B or C, which of the two would you choose, and why?
It will be B, Reynolds.
Why
I
B?
think simply because they both give us the same return, but B has got less exposure.
Yes. So because B, for the same return, B has a less risk exposure, it means we'll choose asset B, isn't it? So that's basically, when you look at now the relationship between risk and return, this calculation is trying to demonstrate to us, the calculations that we're doing so far, they are trying to demonstrate to us something, that under normal circumstances, a rational investor seeks to maximize. So a rational investor seeks to maximize the return for a given level of risk. So the investor seeks to maximize the return for a given level of risk. And at the same time, the investor also seeks to minimize the risk for a given level of return. The investor also seeks to minimize the risk for a given level of return. So when you now look at the risk and return relationship, the investor seeks to maximize the return for a given level of risk, and they also seek to minimize the risk for a given level of return.
Renus,
Mhm.
just for clarity, so are you saying the standard deviation is always related to the level of exposure, the level of risk?
Risk exposure, yes.
Oh, okay.
So your risk exposure in this case, we are taking into account the standard deviation. And please note as well, your total risk is given as systematic risk plus unsystematic risk. The total risk in this case would be measured by the standard deviation. The systematic risk is measured by the beta. So if you take into account your total risk, you are accounting for systematic risk and unsystematic risk. And please note as well, your systematic risk is also referred to as non-diversifiable risk. And your unsystematic risk is also referred to as your diversifiable risk. So in your portfolio, your ultimate aim is to diversify your portfolio by having different securities so that the only risk you are going to be left with there is your systematic risk. So that your unsystematic risk falls away and you're only going to be left with systematic risk. So the question now becomes, the relevant measure of risk for total risk is standard deviation. If you assume that your portfolio is fully diversified, then you can now use the what? The beta as the relevant measure of risk. Are we together there? So this is demonstrated. So this is demonstrated by what we see. So the information that we've given there on that relationship between the risk and return. So the information that we're given there on that relationship between the expected risk and standard deviation is basically now going further to say, when you now look at the efficient frontier, what do we see? If you go back here, do you see that this combination here, where this combination of risk and return, it's not efficient because why would the investor want to invest in something for a certain level of risk? The investor would invest in something and earn this return when they can invest in something on the efficient frontier and get this return. So the efficient frontier is made up of those combination of portfolios which are able to maximize the risk for a given level of return, which are able to maximize the return for a given level of risk and minimize the risk for a given level of return. So which means when we are creating the efficient frontier, this point is not going to form part of the efficient frontier. Why? Because there's a better option. You can be investing at this point and get this return for the same amount of risk. So what does that mean? It means in theory, our efficient frontier should start somewhere here and leave out this point, because this point cannot be found on the efficient frontier, because we need to, on the combination of assets that are found on the efficient frontier is the combination of assets where, or portfolios where we are able to maximize the return for a given level of risk and minimize the risk for a given level of what? Of return. So what this means, if you are now going to go to, if you go to the next section where they talk about the efficient frontier, they are basically saying that in effect, the efficient frontier would be given as this, where you're looking at the combination of the expected return and the standard deviation. So the portfolios which are found along the efficient frontier are the portfolios that you'd want to invest in, not portfolios which are found within the efficient frontier. Because the portfolios which are found within the efficient frontier, they are not able to maximize the return for a given level of risk, and they are not able to minimize the risk for a given level of return. Are we on the same page? Then, now you can be able to extend the efficient frontier, considering the case where you're able to borrow or lend. So you're able to extend the efficient frontier, given that you're able to borrow or invest at the risk-free rate of return. So which means in this case, they say, when you now look at the efficient frontier of all investments, they say point I is achieved by investing a percentage BI of available funds in portfolio M and the rest in the risk-free investment. So which means if you want to extend the efficient frontier, where you want to find your efficient frontier along this line, not necessarily for it to be curving, it basically means that if you're able to take into account that you're able to borrow at the risk rate of return and invest and earn a certain return as well, your efficient frontier is going to be something like this straight line. So here they say point J is achieved by borrowing at point B minus 1, BJ minus 1 of available funds at the risk-free rate and investing everything in portfolio M. So if you invest everything in portfolio M and you borrow at point, if you borrow at point BJ minus 1, so this will give you a return where you are able to get a return which is going to be plotting along the efficient frontier, which is basically a return J there. So the main idea behind the efficient frontier is that you want to be able to maximize the return for a given level of risk, and you want to be able to minimize the risk for a given level of return. Any questions on what we've done so far? So I don't want to go too far because there are so many other students who are supposed to be joining us, but because the registration is not done, we need to give them a bit of time so that they're not too far off behind, especially when it comes to study unit 2, because there are some important calculations there which I need people to be able to know exactly how they're done. Because I still remember there was a calculation in actuary calculation that was brought in the Gen-Feb exam as well. So please go back and review what we've done so far. Please go over the videos of what we've done in last year's class as well. And for those who don't have access to the user account on the website, please let me know so that I can also create for you that access, even for those who came in for the temporary class as well, for the trial classes as well. Please, market risk, there's a lot of calculations which you have to do. And just like math, The only way you're going to be able to master those calculations is if you practice. So for you to be able to pass market risk, please keep practicing. Know your financial calculator, or know whatever calculator that you're using, whether it's a scientific calculator or whatever it is. Know your calculator very well, and you should be able to know how to do this calculation, because there is no painful thing as you know exactly how you're supposed to be doing the calculation, but because you're under exam conditions, you start making mistakes on your calculator where you either get an error message or you start getting the wrong answer as well. Remember, for market risk, expect a long calculation that you need to do for a very small mark allocation. Expect that. If you look at past papers, I'm not saying do the past papers, but if you look at past papers, as we go through the different concepts that are going to be doing there, if you go and look at the type of related questions that have come in past papers, you see that some of the concepts, you do a lot of calculations, but the mark allocation would be very small. Sometimes you even do a long calculation only for 4 marks. Very possible. So to accumulate as much marks as possible, please keep practicing. Are there any questions? Also, please take note. I know it's a calculation type of class as well. What we usually do is that if we're going to be doing a full 3-hour class, after 1.5 hours or after 1 hour, 20 minutes, we take a break for about 5 to 10 minutes, then we continue as well. So it's not like under normal circumstances, we're going to be cruising through the 3 hours nonstop. Normally, we break it down into 2 parts. The class will break it down into 2 parts where we need about 5 to 10 minutes break as well, or even 15 minutes, depending how much material we're covering. All right, enjoy the rest of the weekend. Please keep practicing. And as time goes by, we're also going to be looking at assignments as well, but I'll guide you on exactly how we're going to be approaching the assignments. In the next class, I'll give you a guideline of how we're going to be approaching the assignments as well. All right, enjoy the rest of the weekend.